Well, let's go to Oliver Sloup of Blue Line Futures. He's based in Chicago, and we'll talk about this market action here for a while. Extreme choppiness in the grain markets here. Corn and soybeans going opposite directions right now. How come?
Yeah, well, you couldn't explain it any better. Extreme choppiness, and that's to be expected this time of year, where weather changes pretty quickly over the weekend throughout the Midwest. This is nothing new. So we're in that time frame where you expect gaps come Sunday night, one way or the other, depending on what the weather is and what the forecasts come out as. Now we're seeing soybeans recover a little bit better than corn, which is encouraging, and we're taking out Friday's highs, which bodes well for the bull camp. Although we did do a lot of technical destruction last week. So the bulls still have their work cut out for them, but getting out above Friday's highs is the first step in repairing some of that technical damage. If we can get a closeout above that 1430 area in November new crop beans, I wouldn't be surprised to see this market rally back towards the breakdown point from last week, 1475, going into that USDA report here later this week.
What's your take? Do you think the market is fairly open to maybe some reductions in acreage this year?
I think the market has done a pretty darn good job at pricing in a lot of that. And it's going to be interesting to see how the market reacts when the numbers are released on Thursday morning here in Central Time. I'm still a little bit cautious, being too optimistic, these grain markets. Seasonally, this is a bearish time of year for the markets. Corn specifically, looking at a seasonal in the September futures contract from June 14th to July 27th, the market's trended lower 13 out of the last 15 years. So hoping for a bigger, significant weather rally has proven to be a bit of a disappointment historically. So again, working with a lot of producers, reminding them that it's okay to be optimistic and upbeat, but it's more important to protect your bottom line. There's ways to do that while keeping your upside open.
I know a lot of analysts have drawn parallels between this year and 2012, and they said in 2012 we made a late high in the market in corn. I don't think it was till like August or something like that. Could we maybe be following that pattern?
Well, I have seen a lot of people talking about 2008 and 2012. I draw the comparison at 2014 from a risk perspective. 2014, we got a sharp sell-off, about $2 from the highs, and a lot of people were expecting or waiting for a relief rally to get hedges back on or get out of their speculative long positions. In 2014, that bounce never came. We went from about 550 down to about 350 from the middle of May to September without a bounce and an opportunity for those hedgers to get back in. So I'm kind of scarred from that year, and I have a very vivid memory of it. So again, it's important to protect your downside risk, and you can still remain optimistic while protecting that.
Good advice.